And then, good news for all of us here is that the private equity community has raised about $1.5 trillion of capital. Let that sink in, right? And more is being raised. And they also have the debt. So there's $7 trillion of dry powder to do deals. And private equity is not paid to sit on the cash. They're paid to go do those deals. The good thing about private equity is they will move much faster than strategics. Strategics will take a while. You need a business unit sponsor to buy into the vision. Then they will push the corp dev to do the deal. But with the private equity, they have a financial checklist and metrics along with the market thesis. You might be in the market they're investing in. Then they will look at your financial metrics, and if you fit in, they can move pretty fast. The one caveat with private equity compared to strategic is they generally pay a little bit less. The private equity will index more on the financials.
Hey, everybody. Welcome to the Practical Founders Podcast, where every week we hear an amazing story from a serious founder who built a valuable software company and did it without big funding. I'm your host, Greg Head, and this week my guest is Gaurav Bhasin, the founder and managing partner of Allied Advisors with an ERS at the end. He's an investment banker, M&A advisor for software and tech companies in that sweet spot for practical founders, that $20 to $100 million exit zone where the big banks don't really help and little guys, it's too complicated for, solo M&A advisors to help out or do it yourself. We talk about what's happening in practical founder M&A in that range with AI and financial buyers, strategic buyers, growth rate, size, the factors that are playing in, what's happening this year as we get through this market. And he shares a lot of information there. He's got some great resources that he shares on his website, but we talk about what's reasonable for practical founders in the range of growing companies to 10 million in ARR and beyond. Hi, Gaurav. Welcome to the Practical Founders Podcast. Good to see you.
Nice to see you as well, Greg. Good to connect.
We met in person last month in Park City at the Lighter Capital Summit with bootstrapped founders and in the room and lots of experts like yourself. You sat across from me at a dinner event and you remembered my podcast, and you remember we had a little email exchange. You work with one of the founders who was in one of the first Practical Founder peer groups, Landon Taylor, when he sold a piece of his business there. And I met some more of the founders you worked with at that event as well.
That's right. Yeah, good to reconnect, Greg. In fact, I really enjoy your podcast. And I do think, there's a world out there and there should be more focus on bootstrap founders, getting customers to fund your business, grow it the good old-fashioned way, which has never really gone out of favor. And I would argue for 99% of the businesses out there, growing it bootstrap is probably the right approach. So thank you for putting a spotlight on this category.
Well, and you're in Silicon Valley. You're, a tech M&A advisor. I guess would you also say investment banker?
Yeah, that's right. I've been an investment banker for about 20 plus years. I live about a mile and a half from Sand Hill Road in Menlo Park, which is where 80% of the world's venture money is. And they have seeded some of the best companies in the world like Google, Facebook, and many others. So,
yeah. And so is that a little ironic, or do you feel a little out of place being at the epicenter of the AI revolution and the funding game? I've spent plenty of my time on Sand Hill Road back in the early days when I was doing the venture funding game. Does it feel odd to be, bootstrapped friendly in Silicon Valley?
I think in the Valley, so we have had the pleasure of working with both venture-backed and bootstrap companies. I do tend to see more bootstrap company outside the Valley than in the Valley.
Right.
In fact, you met with one of my former clients. He also lives in the Bay Area. He raised a seed fund from one of the top investors in the Valley. But then he saw the customers were funding his growth, and he decided not to take any venture money. And that actually worked out to be better for him because he didn't become a company like Databricks, but he had a pretty nice outcome. And because he owned a big portion of the cap table, he was much happier not having taken the venture money and eventually bypassing the Series A, B, and C and exiting to a private equity firm. So, I do think there's merit in taking venture capital too, but I think if you do take that route, you need to be going at a much faster clip than growing 30, 40, 50% a year. You need to be doing triple, doubles. And if you hear Hemant Taneja at General Catalyst, he said the new type of companies I'm looking are not the companies that grow from 1 to 5 to 15 million. The kind of companies I look to fund are the ones that grow from 1 to 15 to 100. So, of course, we all know about those companies, but there are not too many of those. So you got to be careful that if you're
Yeah,
not a cursor or if you're not a lovable, you're setting up yourself for, the big stake game. So just know what type of game you're playing.
that's right. The first rule of the game is know what game you're playing. Are you talking about Darshan
Yeah.
Rangagauda?
Yeah.
Yes, at Yale Grad Hills. He's going to be on the podcast in a few weeks. So we met
Great.
him at the Lighter conference. There was plenty of great founders there. Lighter Capital, of course, provides non-dilutive funding to bootstrap founders to help grow faster. So not in the startup stage, but in the scale-up stage when you know what's working and you can do it efficiently. So, Gaurav, let's just start with what your focus is these days, and then we'll get into all the interesting topics around M&A and selling your bootstrapped practical SaaS software company in 2025 and beyond. Well, what's changing, what expectations should people have, what's interesting there. Really important topic for founders who are seeing an end game, in the next few years. But first, let's talk about what is your business, Allied Advisors, and who do
Sure.
you focus on, and what's your specialty?
Yeah. So, Greg, I've stayed in the same business for the last 20 years, essentially being advising companies on financing or exits, primarily exits. I started my career at a bulge bracket. We took companies public. In fact, back then we took a company public called Monotype Imaging. They were sub 100 million, 60 million, and we, along with JP Morgan, took them public. That market has changed dramatically. Today, you need to be half a billion to go public, and that scale keeps going up every year. I feel like having realized that one of the things is I think M&A has always been a dominant form of liquidity for founders and companies, and that's really where I focused on. Closed nearly 100 sell side transactions in my career. Focus primarily on B2B SaaS business, and nowadays we're seeing a lot of these businesses either they're AI native or they're embracing AI as part of their offering to their customers. So we work with technology companies, help them find strategic buyers. And the last few years at Allied, we have found buyers like IBM, Alteryx, Walmart, Activision Blizzard King, SolarWinds, top tier private equity funds like K1 Partners, Fransco Partners, Clear Lake, Spotlight. We're doing a deal with a major private equity firms of the likes of Mr. Thoma Bravo currently. But that's really been our bread and butter, focusing with the technology companies, either finding them a strategic buyer or a private equity buyer or a strategic backed by private equity.
Right.
Like I said.
That's right. And that's great. And not all founders who are on the listening to this podcast and in my practical founder peer groups are saying someday I'm going to sell this company. A lot of people want to run it for a
Yep.
long time and exit a little every year through profits and have fun with their business and grow it bigger. Right? There's a place for that as well. So we're going to talk about the M&A game today. Let's talk about Allied Advisors. You're the senior
Sure.
banker, advisor on your team, so you work with founders directly. Who's on your team? How many people are involved? I know you
Sure.
deal with smaller companies, so it's not a big bank or a big team, but
Sure, sure. So, generally, in all deals, we generally staff a deal with two senior bankers. So, I have another partner who will work with me side by side on any transaction. Plus, we have a former partner and a colleague of mine. He sold two companies. He also ends up backing us up. So, there's three folks who are staffing the deal. Plus, we have a set of junior bankers who will help us with material prep, help us get the data room ready. So essentially, we have a full sort of service team that goes and services these clients to get a good outcome, which is also one of the reasons why we're able to close transactions successfully with a lot of top tier, well known names, whether it's a Fortune 50 company like IBM or a Walmart, or it's a private equity firm, the ones
yeah.
we just mentioned. So.
Well, it's not a simple thing to sell the company, and
It's not.
more than half of the founders who have exited fully strategic or private equity or exited partially to private equity backed, have used an M&A advisor and give the thumbs up about, "I'm glad I did it. It, created a better deal for us. It got
Yeah.
us through the process better.
Uh-huh.
It helped us pitch it better," and so forth. Why don't you just take a moment for our practical founder audience and share the biggest benefits of working with an advisor versus doing it yourself?
Sure. So, as founders, you're hyper focused on building your business. You're not focused on selling your business. The benefit of having a founder come in is they're aware of what the market looks like. They can kind of tell you for your type of business, who are the buyers who are likely buyers in the strategic, who are the likely buyers in the private equity universe. A experienced advisor should be able to kind of give you an estimate of where the value of this company might be to a strategic, to a private equity firm. So it gives you a good kind of a market check. And if the value isn't enough for you today, what you can do to get to that value. The other thing is what an advisor can do is they can help you reach out to these buyers because you don't quite know who to reach out to at a
Yeah.
strategic buyer, whether it's a Databricks or IBM, who is the person to reach out to. If it's a private equity firm, who are the right folks to reach out to. The other thing is, I would like to keep it simple. If you're selling a house, you're not going to show it to one buyer. You're going to do an open house to get a bunch of people through your property and try to get multiple bids. A good advisor can help you create that sort of competitive environments. And you'll be surprised, Greg. You sold your company before, and when you did, I'm sure if you ran a process, you got different bids. They had different values, right? So
Yes.
that's a market discovery process. And candidly, buyers can pay more. They're not going to put their best foot forward. But I think a good advisor can put some tension on them to make sure they sharpen their pencils. They give you the best value for your company. And also another thing to keep in mind, Greg, is for these founders, they're going to work with these buyers for next 2 years if it's a strategic. If it's a private equity firm, they're going to be there for
Probably
five
longer.
years.
Yeah.
So, there's a delicate balance. They are going to be your future bosses in how you negotiate with them, And one more thing for the founders is that, you do this once every 5 years if you're lucky. The M&A guys at these corporates do 5 to 10 deals every year. The
Yeah.
private equity firms do a lot more than that. So you want to level the playing field and make sure that the advisor you work with knows what the market conditions are, know where the valuations are trending, know who are the good buyers who pay up, know the ones that are bottom feeders, and kindly kind of tell you if this person is kicking tires or is serious about it. Plus, there's a lot of stuff that goes into running a process, whether it's preparing
Oh,
the
yeah.
materials, preparing the day room, being your sounding board, being your friend, psychologist through the process. It's a pretty emotional process. So having someone who can work with you through the process is pretty helpful. So
That's great. And so at Allied Advisors, what size of company do you focus on, right? There's big M&A banks, an investment that works with the big public companies and large deals, but you work with, practical founder size companies.
yeah, so we generally target, I would say, middle market M&A deals, and these deals are generally 200 million and below. The
In
bulk of
ec in
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 in equity value and in
equity value.
enterprise value. So, but I would say a bulk of our deals, 95% of the deals we work on are generally 100 and below. And Greg, you've been in the industry long enough, 98% of deals are below 200 million. There's very few deals that are above a billion, above
And
half
95% or something are below
100
100,000,000,
million. Yeah,
like exit value,
exactly.
and we only hear about the billion-dollar
Yeah.
exits, the Wiz or whatever that gets acquired for 35,000,000,000. We don't hear about all the practical deals out there for under 100,000,000. And by the way, no VC would invest if you said, "We're gonna put all our energy into this and exit for 100,000,000, right?
Yeah.
So
And VC look at the power law, right? They're hoping they have a
yes.
Wiz in their portfolio that'll give them the outside return. They're hoping for the Facebook in their portfolio, but they have a broad distribution. And that's what founders need to realize. If you are a Wiz outcome, sure, it's great for the investors, great for the founders. But if it's generally $100 million or below exit and you've raised a bunch of capital, it may not be
Yeah.
that good outcome. So,
Which means 0 for the founders, which is the common case for VC funding. 75% of VC funded founders don't walk away with anything because they don't exit for billions. And in your state of tech report that you shared at the conference and afterwards, we'll put a link to that in the show notes here. You kind of did a number of deals by exit size graph, which is another one we just don't hear about, right? 90% plus of all the deals are in tech are exiting for under 100 million, VC funded or not. And only about 300 deals in the last 5 years have exited in the $1 billion
Sure.
range. So all this excitement, all this funding to just go to a small corner. What about the tens of thousands of other valuable businesses out there? That's what Practical Founders is all about. So,
Yeah, and the problem is, media sensationalizes the big deals, right? Everyone hears
yes,
about the WhatsApp deal, the CyberArk deal, but these 20, 50, $80 million deals, that's what keeps the market humming. And
yeah,
frankly, that's what healthy for the tech ecosystem, both for
yeah,
the strategic buyers, private equity firms, for
right.
the founders. It's a circle of life in tech.
Right. It's life-changing for founders,
Absolutely.
or founder, and it's not too huge that a large company can absorb it and get the benefit out of it, right? It's hard to benefit from a billion-dollar acquisition,
Absolutely.
if it doesn't turn into a multi-billion-dollar
Yeah.
game
Yeah.
there. So, how many deals are you doing these days in the B2B SaaS or software world?
So since we started Allied, we have sold over 30 companies. So on average, about 5 to 6 deals a year, closed deals.
Yeah,
Yeah. So that's what we do
okay.
typically.
And so these are founders who are saying, it's 5, 10, 20 million, and we are thinking about selling it. Maybe they get an instigating event, an offer comes in and starts the process, which I think Darshan experienced. And
Sure.
then we want to go shop it, keep everybody honest. But they're thinking about that range, 20 to 100 million, something like
Sure.
that. And they call you and you start helping out, right? So how long is a deal taking? And by the way, like before we say, I'm going to ask some questions to say what should founders expect and what's going
Yeah.
on this, second half of 2025. There's always a range. It always depends.
Sure.
But let's kind of start with the range. How long does a deal take to close, or should it take, like a typical deal?
So Greg, the deal timeline has elongated, unfortunately.
Ah,
Yeah, before the bubble, you could probably have a closed transaction in 6 months or so. Now, now from start to finish, you're looking at 9 to 12 months. And
really?
there's the marketing phase when you're preparing the materials, you're preparing the data room, you're reaching out to the buyers. Then there's the meeting phase. If you're lucky, between all the meetings and management presentations, you get a LOI bid in 3 months from the launch of the marketing process. And then, the diligence and the purchase agreement, if you're lucky, will be about 6 weeks, to get that
Okay.
done.
Yeah. Yeah.
But what happening now is the buyers are more diligent. They are bringing armies of folks to do diligence, whether there's your accounting, finance diligence, your technology diligence, trying to make sure the deal is really right for them because, the era of free capital is over. They
Yeah.
want to do all their synergy analysis. The purchase agreement can get elongated because the lawyers for the buyers are, trying to protect every type of risk possible. Sometimes if the company is larger, you're expecting a QE or quality of earnings, even if
Right.
you've done it yourself.
An
So all of
assessment
these
of the quality of earnings, yeah.
yeah. So all of these things do take some time. And unfortunately, it just meant that the deal cycle has kind of gone from start to finish to about 9 months to 12 months. Of course, if a party is super interested and they're willing to pay up, it could close in 6 months or less. But I would say for planning purposes, you should plan for 9 to 12 months. It's just how
That's
it's
a
been.
lot of time, a lot of work, a lot of stress, a lot going on there. So it's 2025, the end of 2025. We had the boom times and the zero interest rate, easy money game of late 2020, 2021, where due
Sure.
diligence was kind of thrown out the window and everybody was anxiously doing deals. But and then we had the opposite of that, everything slowed down. But is there an active market? They're just being pickier, or
Yeah. So the way I would characterize this is, in the bubble, the aperture has become this wide. Almost every
right?
company was getting sold, right?
Right.
Today, the aperture has narrowed quite a bit, right?
Ah.
Everyone sort of got the memo, whether you are bootstrapped or venture back. And actually, bootstrap guys, not so much. They didn't have a choice. They had to run it profitably. But the VC backed companies, a lot of them said, if you're not scaling and not growing that fast, you can't be burning a lot of money. So, and the buyers also are very, very careful because they got the memo from their public investors, or if it's a strategic or a strategic backed by private equity, more so. The private equity, they're very disciplined financially. So they're not going to buy a company that's, growing 40% and losing 40%, right? They rather buy a
Right.
company growing 20% and EBITDA of 20%. So those are more in vogue. So they look for, while everyone looks for growth will always be a factor people will look for in good
Mhm.
markets, bad markets. But the era of, growth at all costs is out of the window. People want profitable growth, sustainable growth, and growth that they can kind of count on. So I think there's sort of emphasis on that. And that's why the number of deals, people are more picky about what they do. So aperture is sort of tightened. So unless
Yeah.
you're an AI company, in which case, you know,
Yeah, so the aperture is
that
big again. Right.
that's a
Yeah.
different topic.
Well, and that's a different
Yeah,
game, the rocket ride game that
sure.
venture is now oriented around. And there's a certain swim lane for that. But, our practical companies, I guess it means it's a good thing for steady growers, practical companies that are rule of 40, rule of 60, rule of, 80 kind of companies that are well managed and sticky and have reasonable profits and a steady growth rate, compounding kind of growth rate that will continue. Does that mean that the practical software companies are sexier and the overfunded, not so profitable companies are not sexy anymore?
Yeah. So, I put up a chart in that presentation, which I think you
Yeah.
saw. I think the ones which are having a good outcomes are these steady Eddie companies, right? Which are growing nicely, break even, maybe profitable. Those are getting good outcomes. The ones which are highly funded, but a lot of high cash burn, don't have a good business model. Unfortunately, there's not a buyer for them. And we are seeing some of that in the market, right? So I think, there's a value in compounding. And you know this well, Greg. If you're a 1 million ARR company growing 30% every year is 7 to 8 years, whatever the math is, you're going to be a 10 million ARR company.
It's 9 years. I just did that math for my podcast last week. So, yes,
Okay, there
and
you go.
another 9 years to turn it into 100.
100.
And so,
Yeah.
okay.
And,
So,
the valuation, if there's 5x or 10x, is you got a half a billion to $1 billion company.
yes.
And those companies will endure because, you built it sustainably
Yes.
on a customer need. So, that's really the magic. So,
Well, let's dig in here with the current state of play. How would you describe 2025 in the software M&A world? Is it, it's like another rational year of reasonable companies buying reasonable acquisition targets for reasonable multiples and, reasonable growth rates? I know there's crazy and,
yeah.
opportunistic on all sides of things, but are we in a reasonable zone and is that likely to continue?
Yeah, I think so. The good news for founders who are looking to sell this year or next year is the market's improved tremendously. Greg, what happened is pre-bubble, there was a certain level of deals. It was about 5,000 or so exits happening.
Right.
Then the bubble happened. Almost everything was selling. The Bessemer SaaS index, which you might be following, you
Yeah.
know, went from like 6x to 17x, right? It was good times. You should have sold. Then everything crashed, right? Then there
And
was,
this is 2020, 2021. A lot of
yeah,
founders who've had on the podcast, right,
yeah,
got their multiple kicker because they sold at the high
yeah.
watermark. Yeah.
Exactly. And then COVID boom and everything was being digitized. But then people realized, hey, this trend is not sustainable. This actually it reversed to the what sort of historic trends. Well, guess what? The valuations have actually now are slightly higher than it was pre-bubble. So the valuation gone up for public companies, they're about 7x. And actually,
Yeah.
we tracked the number of deals. They're up 20% from what it was pre-bubble crash. So
Okay.
all in all, if you ignore this bubble period in there, we actually going slightly above where we
Yeah.
were, pre-bubble. So it's good news. And again, now the valuation is slightly higher than what it was, pre-bubble. The number of deals is higher. And we're seeing this both in large, by the way, a lot of large cap deals are happening. You had the biggest outcome
Yes. Uh-huh. Yep.
with Wiz, Google,
Yeah.
CyberArk got bought. And also a lot of these smaller deals are happening where, companies are looking for the right type of company that will build a sustainable business that a strategic buyer can take the GTM team and take it from a $10 million business to $50 million pretty quickly with their sales team. And they like the businesses that practical founders pray. So
Well, let's talk about strategic versus financial buyers. Can you describe? I mean, this is just the beginning of the M&A exit story, the basics here.
sure.
What is strategic, and what do they want generally, and what is a financial buyer, generally private equity? What do they want generally? I know there's ranges in all of those, and there's the one in the middle, which is the strategic that's owned by private equity, which is a little bit of a blend. Can you
Sure.
just describe strategic versus
Yep.
financial buyers and what's happening today?
Sure. And for the viewers, you probably know this. Strategic could be a company like IBM or a Microsoft. A private equity could be someone like a Thoma, Bravo, or Vista. So generally, the strategic buyers, when they go acquire a company, they're trying to look at three T's, I like to call them. They look at the tech, what kind of tech you build. Is there something that's very substantial, which would take them many years to build? Well, if
Yeah.
it took them many years, they'd rather buy the company today and get this tech in-house. And these are generally done well by practical founder engineers who've got a technical background but just got frustrated working in the company. So they went and started something. And then the strategics realize, oh, wait, we should buy this company. So they need good tech. They also need good teams, right? I think, if you've got the right tech credentials, they like it. And they also want some proof point. Now, these strategic buyers don't necessarily need you to have 10, 20, $30 million of revenue. If they find that you on your own could get JP Morgan as a customer, and you might even be 3, 4, 5 million ARR, but you're doing something really cutting edge, which is taking you 3 to 5 years to build. Can they build it themselves? Yes, they can. But they look at this M&A as more of an outsource R&D, where they
Yeah.
can bring this in-house quickly, and they have the distribution to make it scale, right?
Right.
So for them, the tech
Your company is worth 10 times more or 100
yeah,
times more inside Microsoft than it is outside because of
yeah,
their
exactly.
distribution
And
and their
that's where the
brand up.
synergy is. And that's
Yeah.
where they're willing to pay you much more than a private equity because they can kind
Right.
of grow and scale it faster. Sometimes it could also be a bet for you to get into a new market. Like, for example, when Google bought Wiz, they're trying to grow the security practice because their ad
Right.
business is, slowing down with sort of AI
Yeah.
coming in. They're seeing the pressure, but they have a lot of capital. So they want to be big in the security space. In this case, they paid, I think the multiple was like 30 times a billion of revenue,
Yeah.
right? So,
Uh-huh.
but they were willing to pay for a premium asset to get in the space. Good example is Cisco. Cisco was a hardware router company, and you know this, Greg. You've been in the tech space for a long time, but today they are selling security, and they have kind of,
Everything.
yeah,
Yeah.
boosted their way in by buying these prize assets. So, strategics will either buy the premium assets in the space like a Splunk or a good security company, or they will do these tuck-in deals, which is where a lot of these deals happen at
Yeah.
good multiples. So for the
Yep.
practical founder, that's the exit path. On the other hand, you know, and you could grow your company to 5, 10, 15 million ARR, but you could be in a vertical SaaS space, or you could be in a niche market. One of the things strategics don't like is if your market is not in the billions of dollars, they're
Right.
not as
They can't
interested in buying
explode
it.
this business, right, with your
Yeah.
technology. Right.
Yeah,
Yeah.
exactly. And then, good news for all of us here is that the private equity community has raised about $1.5 trillion of capital.
Yeah.
Let that sink in, right? And more is being raised. And they also have the debt. So there's $7 trillion of dry powder to do deals. And
Right.
private equity is not paid to sit on the cash. They pay to go do those deals. The good thing about private equity
Ah,
is they will get they will move much faster than strategics. Strategics will take a while. You need a business unit sponsor to buy into the vision. Then
right.
they will push the corp dev to do the deal. But with a private equity, they have a financial checklist and metrics along with the market thesis. You might be in the market they're investing in. Then they will look at your financial metrics, and if you fit in, they can move pretty fast. The
Yeah.
one caveat with private equity compared to strategic is they generally pay a little bit less than the strategics because
Oh,
strategics
yeah.
have
Yeah.
the GTM to kind of do it. And then also with private equity, while the strategics will spend a lot more time on your tech and the team, the private equity will index more on the financials. So, it's a different type of a sales tool, depending on who you're selling to. And then the strategic backed by private equity is a good avenue for a lot of founders to consider because, sometimes these strategics, the public strategics, take a while to move. But the strategic backed by private equity, they have the synergies, GTM synergies, but they also have somebody who can fund them to move quickly. They don't have the pressures of being part of a public company, and a lot of these private
Right.
equity firms buy these strategics to hold them for 5 to 10 years. They grow them through acquisitions. They improve them through operational improvements, and then you get the best of both worlds. And then they could be a good acquisition candidate for you. And the good thing about being acquired by a strategic, which is backed by private equity, is you don't have to be that big. If you are reasonably, large, you can find a good home for them. So.
Well, I'm hearing stats like 75% of software M&A transactions are being done by financial buyers, private equity backed, and 25% of number of deals, probably not the same in deal size, but are being done by strategics. Does that jive with what you're seeing?
Yeah, so I think in terms of the dollar value, I think strategics are probably still a little bit higher, but I think the
Yes.
number of private equity and strategic backed by private equity has gone up
Number of
in the past
deals,
few
you're
years.
saying.
Yeah,
There's still more strategic. Yeah.
yeah,
Interesting.
yeah, yeah. In fact, when I first started the business 20 years ago, very rarely you would see private equity generally get engaged. But over time, private equity realized, wait a minute,
Yes, right. Yeah.
why are
They
we
didn't
investing in.
really exist in a major way 20 years ago. Now it's a major part of the market.
Oh,
That's
absolutely. And if
yeah,
anything, they create a catalyst for a process. And at least they can tell you what the market is and how much they're willing to pay. And if you can get a strategic in the mix, it's best of all worlds. But I think you will continue to see this increase because, they like the recurring nature of SaaS businesses. It's
right.
like cash flow for them. So, yeah, they're getting involved.
This podcast is brought to you by my friends at Fraction. Are you stuck at your 7-figure ARR with tech challenges holding you back? Whether it's tech debt, slow feature delivery, or other scaling challenges, you're not alone. Every founder hits this wall. That's where Fraction comes in. Fraction gives you access to senior US-based engineers and CTOs without full-time costs or hiring risks. Fraction founder Praveen Ganta is a practical founder himself who has been on this podcast. He grew his bootstrapped SaaS business, Hidden Levers, with fractional talent and sold it for more than $100 million. Fraction's experts come in to fix problems and do real work, not just give advice. Fraction is flexible and founder-friendly. Get 10 to 30 hours per week from vetted and experienced US-based talent. And you could start with 1 week risk-free trial to test it out. Find your next fractional senior engineer or CTO at fraction.work. Now back to our podcast. No, that's right. And practical software businesses are generally aligned with the private equity approach, steady compounding, and profitable, and not trying to be a billion-dollar revenue company. You probably won't get there, right? Not an ideal fit for the venture funded here. Is it fair to say that if you sell to a strategic, you're more likely to buy a majority or all the company, more likely to get a cash out, like that was the old way you used to do it. And then if you sell to private equity, you're gonna sell a minority, majority, and you're gonna have to roll your shares and stay with it. It's a different kind of game, like get your cash and go. Used to be the old strategic way. It's a longer term. You have to partner with them, invest
Sure.
in their company, roll over your shares. Is it fair to say that that's the difference, one of the big differences between strategics and
Yeah.
financial buyer?
So if you sell to a strategic, if it's a public company, they're going to buy 100% of your shares in the company
Right.
and you're going to get cashed out. But they will also want you to stay with them for 2 years versus you going off to Hawaii
Yes,
because, you have a lot
or
of
a
knowledge.
competitor.
Yeah. A lot of knowledge, you have a lot of know-how, and there could be 2 years where you stay with them,
Yeah.
you get retention payments. Bigger strategics don't do earn-out, but some of the smaller strategics may put an earn-out in there, but usually they expect you to stay for a year to 3 years. On the other hand, if you sell to private equity, because they haven't really run your business, they kind of need you to stay with them because if you leave,
And run the business, right?
yeah,
Continue to run the business.
yeah,
Yeah,
yeah, run the business, or over 2 years, they might find a CEO to come in and take your role if they feel you're not growing fast enough or the way they would like it to grow. But what they do is they will not cash you out fully. They will take 20 to 30% of your value you would have gotten at close and make you roll that into the deal with the hope that 5 years from now, that second bite of the apple is worth bigger than the first bite of the
right.
apple. So, and the rollover equity can be very valuable. If you have a good tax
Yeah,
planner, they can help you with QSBS and other things. But that's typically how you play that game. So,
right. Is that a surprise to founders these days who are entering this process and that they see, oh my gosh, I got to keep going and keep running this business? And, I guess it might be worth the price to put up with that, you know, a board and people that own the majority of your company, and you're reporting to somebody, and you have smart spreadsheet people telling you what they think you should do, right? A common complaint. Is that a surprise to founders, or and most of the founders you're working with are pretty familiar with, that's the price you pay?
yeah, Greg, look, I think if you're a bootstrap founder, in some ways, you've kind of learned to listen to only one person, the voice of the
Yes.
customer, and go where the
Right.
customer is asking you to go.
Yeah.
Now, in my experience, the majority of founders, after 2 to 3 years, find out that their entrepreneurial spirit may not jive well with a private equity ownership.
It takes
You
that
know,
long? Get off it? Yeah, right. I thought it was about after 5 minutes. Yeah.
yeah, but you did get a lot of cash at close. So I think
Yeah.
but what happens is a different owner comes in. There's a different mindset, and
Yeah.
sometimes there's not sort of meeting of the mind. And it's kind of private equity firms also know this. You made a lot of money, it's life changing money, but they have a vision where they want to take the company to, and it's only fair for the new owners, frankly,
Yeah.
to install their own operators to run the business. Kind of like a venture, right? If you're taking the money
Yeah.
from the venture, that's the game you're playing, and you
Yes.
signed up for giving me a
Yes.
triple
Right.
growth. But now you're with private equity. While they may not want triple growth, they will want a certain level of growth and margins. And it's not
Right.
everyone's cup of tea. And some people don't like their supervision or the ongoing board meetings and having an analyst pinging you every day with Excel spreadsheet. And the game changes. So
Right.
so you just have to be ready for that new game, or
Right.
find someone else to play it for you.
Do you get involved with founders who are going to take let's say, a growth equity round, which is typically more of a minority stake as they're growing up? They've grown it to 8 or 9 million, and they see a way to get to 30 million. They're, seeing momentum in the marketplace. They like the game. They want to take some chips off the table. They need a little capital, but it's minority. They still want control for another stretch there. Do you get involved in those, or are most of your deals majority exit, selling most of your company?
Yeah, so the universe of firms that are doing minority investment in these type of companies is smaller than the universe of
Okay.
firms that do majority investments. So you know, uh, the bulk of our business is either sell side M&A or doing a majority raise where the private equity owns 60-70% of the business. Occasionally, we will do a minority raise where they will take 30-40% of the business, give some secondary, give some cash on the balance
Yes.
sheet.
Uh-huh.
But keep in mind, if you're 8 million of ARR, the multiples today aren't that huge, right? So at a $40 million value, these funds have also got a big size check to write into the companies, right? So if it's a small
Right.
check, the universe of potential minority investors come down. Of
Right.
course, if you are 50 million of ARR, not taking any outside capital, there will be a lot more minority investors who can come in. But Greg, the universe of majority is larger. Those who write check into those companies. So.
Well, let's repeat that, Gaurav. It's really important for founders to hear. If you get to 2 million ARR and you're headed towards 4, right, and you're doing this 30%, it takes a little while. There's only so many financial buyers that want to come in at that early stage,
Sure.
right?
Yeah.
And write smaller checks,
Yeah.
right? And help you get out. But as you get to 10 and
Yeah.
20 million, there's actually many more buyers,
Sure.
and there's a premium
Yeah. Yeah.
on that. There's far more buyers the bigger you are.
Oh, absolutely. I think, the magic number is above 10, Greg. They are literally hundreds and hundreds of private equity firm that will be all over you, and you would have probably gotten called with a bunch of them as
Yes.
you went down that path. I think the 10, the aperture opens up this big, and at 20 is even bigger. Part of the thing is, TA, Summit, these all started as smaller funds, but they
They're
became very
huge.
successful.
Yeah.
They became very big and they've gone upstream, but more and more firms keep coming in. But, for 10 million ARR companies, you have a lot of buyers out there, a lot of buyers.
And
So,
it's when you say a lot of buyers, that's mostly financial
yeah,
buyers, right,
that's
that are
right.
buying? Yeah,
Yeah,
kind of thing.
private equity firms.
Yeah.
Yeah.
Is there a similar, sweet spot for strategics? Do strategics wanna buy you when it's earlier if your tech is good, so they don't have to pay a premium when they take over distribution and sell it to their
Yeah.
base?
Yeah, so strategics, they can also do big deals. I mean, they will do big deals if it gives them access to a market leadership, number one position in a new market, right? Like when Cisco goes and acquires companies, their rule is if it's a big company, we will acquire the number one market leader in that space.
Yes.
They're
Right.
not going to go for the number two player, right? But Cisco also acquires a lot of tiny companies. Tiny means is relative for them. A $50 million deal, $80 million deal is
Yeah.
not a big deal because they know what the value of the technology is. They know if they plug that into their platform and distribution, that can become a pretty big unit within that. Like I've sold companies to bigger buyers where, the company may have been 5 million of revenue. 3 years later, they were over 200 million of revenue. And it was just creating a lot of revenue for the buyer, right? So
Inside the
yeah,
strategic companies, right,
exactly
yeah,
right.
right. Yeah.
The entrepreneur couldn't have done this themselves. It's only on a larger buyer could they see the magic happen. But oftentimes strategic will do both. They'll do smaller deals. They will do bigger deals. Bigger deals could be consolidation of market.
Yeah.
Getting into new markets. So really depends.
Well, I mean, and what I heard you say earlier, the financial buyers, I mean, strategic buyers have their own pace as a big
Yeah.
company, right? And their own priorities. And you may or may not be a priority that year, and you
Yep.
have to be a little patient with them. But private equity backed have, they're in the money machine game, and so they got to move it to make it go. But I'm presuming the financial buyers are going to do much more due diligence.
Oh yeah.
And just to verify it and manage risk and so on. So I've seen that, but, is that fair?
Absolutely. I think, a $10 million deal for a Microsoft is nothing. It's like a drop in the ocean. But for 10 million for a private equity is a big amount. They are going to do a lot of financial diligence. Plus, while they're not technically savvy, they hire third-party tech firms, industry experts to come in and validate their technology. So with them, you almost get like almost 2x the amount of diligence you would. And with the
Yeah.
strategic deals can be a little bit faster than doing a deal with a private equity. On the flip side, private equity is easier to get an offer from them than from a strategic. So, but the deal making a little harder with a private
Well,
equity.
let's talk about the flip side of that. It's easier to get an offer, but is that offer likely to stand when they're, deep diving and finding all your holes and being very, we perceive risk averse here? They don't want to buy something, an asset that is not going to
Yeah.
grow steadily. Do private equity financial buyers, I've seen this, right, kind of change their mind. I've seen in practical founder peer groups, founders get reasonable offers from financial buyers, but it was almost like that was what the game they played to do the due diligence to see if there was actually a fit.
So, Greg, there's a couple of things you can do to control it. One is you run a broad process. Hopefully, your practical
Yes.
fund is working with
Keep
a
everybody honest by
yeah,
having multiple buyers.
yeah, exactly. So, hopefully, the banker advisor you work with got bunch of bids. What we try and do is we do a two-step process with them. We do an indicative offer where we get a bunch of offers depending on the scale of the company. Then you whittle it down to a smaller group, have them sharpen their pencils to get a better offer, but then also make them do a lot of the diligence ahead of doing the LOI and making sure that the offer is not going to, erode from the value they put in. And then one thing you can do to protect yourself is put a 4 weeks exclusivity or a short exclusivity period with a requirement that they produce a purchase agreement within 3 weeks of diligence, right? This way, you're not stuck with them for 3 months while they're diligencing you.
You put a
And
time
then,
limit on them. You give them the exclusivity, like somebody gives an offer, "We'll work with you, we're gonna go through due diligence, but you got 3 weeks." Yeah.
yeah, Yeah, give them a short exclusivity period, and make them aware that they're not the only game in town. There are others, and that if these things change, then you will probably not do a transaction. And I think one of the things founders can also do is be well prepared for the process. Make sure your financials are up to date. Make sure you have a good CFO in place. If you're trading off revenue and EBITDA multiples, try to get an independent quality of earning report done. Try to perform well during the process, that your revenue keeps growing. Any issues, try to bring them up front so that later it doesn't come up as an issue. If there's customer concentration, make sure that the private equity fund that puts a bid in is aware of it before. If there's technical debt, try to fix it. Try to be using microservices, whatever else you need to use, but try to have a clean house so that less issues come up during diligence.
Right. So, meaning there's all the variables that go into, is this a good fit for a potential acquirer? And are they a good fit for the seller? And all the factors that go into valuation and the terms there. Let's go through some of the biggest ones there. The growth rate, right? What is a growth rate for a bootstrap software company that is, let's say, top tier, top quartile? Is it something over 30%, or is that over 50% or over 100% for a
Yeah, so these numbers keep changing. Earlier
Yes.
customers more willing to buy a product. Today they are less willing to buy the product, right? So the
Yeah.
growth rates have come down. We would say the best in class companies have growth rate of greater than 50%. But Greg,
Okay.
keep in mind, it's easier to grow 50% when you're 5
And you're
million or
smart.
10
Yeah.
million than when you're 30 million, right? So again,
Yeah.
what I would do is there's a group called SaaS Capital. They benchmark
Yes.
a lot of these bootstrap companies, venture back companies. You can see based on your size, are you in the top quartile, or are you in the middle, or are you in the bottom? So you kind of
Yeah.
use that. But I would say we like companies with the growth rate above 50%.
Yeah.
We look at retention metrics, and I think this is going to come to bite a lot of these AI companies which are growing very fast. Is
Yes. Uh-huh.
they're not getting good quality customers, they will churn.
Right.
But if your net retention, and again these numbers have changed over time, we like to see net retention above 110 and gross above 90. And again, these vary based on industry. Some industries like the healthcare tech tends to have better stickiness, but longer sales cycle. Whereas we've also worked in the hotel tech space, the numbers are a little bit lower. But again, try to benchmark yourself compared to peer groups. But for enterprise software, we like the net retention to be above 110, gross to be above 90. One more thing is your gross margin. That's going to bite the AI companies because a lot of them have pretty bad gross
Yeah.
margin. But for SaaS companies, preferably above 75%, even better is above 80%, and for a lot of the practical founders, sometimes we see them put like the cost of their sales and marketing or other aspects into the cost of goods. Be careful, don't do that.
Yeah. Right.
Yeah, but
Yes.
because they don't have an external accountant, just make sure you categorize them correctly, right? It's small
First
things.
mistake.
Yeah.
Right.
So we kind of like that. And then the EBITDA margin is close to break even, or above 20% is good. Again, the way I said it is, if you follow rule of 40, a company growing 40%, zero break even is better than a company growing 80% and losing 40%, right?
Right.
So it's kind of hand in hand. And then look at customer concentration. People don't pay attention to it, but you don't want a customer to be giving 25% of your revenue, because guess what? If the customer churns, quarter of your business is gone, and quarter of your value is gone, or more actually. So
Right.
yeah.
So we talk about this. I mean, this is the survivorship bias that I have on my podcast. I'm interviewing like Darshan and others who've succeeded to grow and exit and so forth. What percentage of companies who think they might want to sell their company this year don't actually sell? They're not growing fast enough. They don't have enough profit. They have some legacy issue, a little churn issue, competitors coming after them, right? It's one of those difficult years. There's a lot of companies that would like to sell but can't. Is that fair to say that, only the good ones make it through the gauntlet?
You know, I think if a company has a reasonable business where it's got customers that pay and value their product and they have recurring revenue above a certain size and scale, and they have some of the metrics you spoke about, there's generally a buyer for it, Greg. The question
Mm,
is, you might be worth 30 million, but, you know, and you might be asking for 80 million. Now, you could get lucky, which is unlikely. There may never be a deal for you, right? We all have met those companies where they just have unrealistic value expectations and, you have to watch
yeah,
the market, right? And I
yeah.
think, sometimes I've seen founders may look at, oh, that company got sold for X. How come I'm not
Oh,
getting sold
classic.
for Y? These comparisons are not the best because, maybe they were working with a strategic for a period of time. Maybe there was already a partnership there. That's why they knew the synergies. That's why they paid up. Or maybe they had better growth than you, or maybe there were some other factors that kind of got them that outcome, right? So everyone's case is unique, and but I see sometimes valuation differences between what you think your value is and what the market perceives it can be a blocker to a deal. So
Okay, so there is a buyer for every type of reasonable software company, but whether the expectations of the founder are in the range of what buyers are willing to pay.
yeah,
And that's kind of the starting point, what we see as founders get to 1,000,000 and 2,000,000 and they start to get the inbound requests, right? All the associates trying to, fill out their spreadsheets and sometimes there's lowball offers, just trying to see if people are desperate out there. At what point should founders start talking to some of these inbound, "Hey, we're interested in acquiring companies like yours," kind of inquiries?
you know, I think a lot of times these private equity firms that approach you, they're not the general partner. Like Thoma Bravo is not calling you to speak to you unless it's a $12 billion deal, right? So
Yes.
it's generally these associates who are trying to, grow up in their firms who are calling you. My suggestion is have a 10 minutes chat with them, 15 minutes chat. For in the first 5 minutes, you'll know if they are right for your company or not. Ask them what industry they focus on, why did they reach out to you, and what.
Ask them the questions.
Yeah, ask them. Yeah, use it to the
Yeah.
way to interview them. But some of the better prepared founders have this running checklist of all the firms that have approached them over the years and who is a good fit and who's not a good fit, right? I would be careful not telling them too much about your revenue and where you're growing from a growth wise because automatically you put a target on yourself because he's going to call you a year later and says, wait, you said last year you were going to be at 10, you were at 7, what happened? So, I would stay away from giving too many specific metrics. I would just give them broad buckets, but try to understand, are they the right fit? And at some point, when you run a process, is this the kind of firm you would like to go after? And just try to understand what do they look for? Are they growth focused? Are they profit focused? Are they specialists in your industry? Are you too small for them? Are you right for
Right.
one of the portfolio companies? And if you are, then maybe ask for introduction. Companies generally buy companies where they know each other, and that's true for private equity too. Some of the better deals is where they've kind of known you for a while. But I would just be careful not to give them precise detail on your company because then they have a tracking mechanism on you. And with business, you can never know. Some years you have a good year, some years may not be that good, and you don't want to be the founder that keeps missing the numbers every year they call, right? So I would be
Yeah.
careful with sharing too much details with them.
Right. So, and you should be asking the questions,
You
keeping
should-
track of them. But, what percentage of what percentage of those conversations could be considered a good fit someday? Is that like 10% of all of these might be a fit for the industry, the size, the growth trajectory, the personality, those kind of things?
Yeah, I would say number is probably a little bit higher, like 20-25%.
Okay. All right.
Almost all our clients get approached by private equity. And the better ones are the ones where they say, hey, I'm I did a deal in the backup recovery space. I see you're doing this backup recovery in this marketplace. We just exited a company. We're looking to buy another company, or we have this company. They come with you with a thesis and they've done their research on it. And that itself will tell you that if they're a good fit for you or not. And those are the ones you want to kind of stay close to. And some of the emails are very well targeted, that we have a track record of investing in these 6 companies in the space. We know vertical SaaS well. This is what we do. We invested in Toast. We invested in this, that, and then, you know, why do you think you're a good fit, right? I think those are the ones where I think you should probably stay in touch with them.
Right. And are you staying in touch with them as, when you, work with a new, founder
Yeah.
as and representing them to go shop their companies here, you're maintaining these relationships and filtering and scoring them for who's a fit and who's not a fit and all of that.
Yeah, so we know like which firms are right for a 10 million ARR company, which is right for a 30 million ARR company, and which is right for the sub 10, the 3 to 10 ARR
Yeah,
company. We have a database of that. We also know the firms that are notorious for retrading. They'll always find issues. We also know firms that, are good in their word. We also know, which ones are easier to work with and which ones aren't. We have industry dynamics. We've
yeah,
been doing it for a long time. So we have a good sense of, who the right buyers are. And also we know which ones are going to be very valuation sensitive, which you may or may not want to go to. So
right. And valuation is just one of the terms, right?
yeah,
It could be
awesome.
for the founders, how long do I have to stay? What percentage do you want? Those are terms I hear about. Are there other terms that
Yeah.
besides the valuation that, are in the main negotiation?
Yeah. So, while I say, the headline number is important, it's not the only factor, right? You got to look at it as, I might give you $100 million deal, but I'm going to give you 2 million of cash, 98 of stock.
Yeah.
The stock you may not be able to
Yeah,
cash
that's what
out.
we don't hear when we see the $100 million deal. We don't see that they got
Exactly.
2,000,000 upfront and it'll probably deflate.
Yeah. So you need to figure out how much is cash, how much is stock, and if it is stock, what's the value of the stock? Is there a preference stack on top, or not? What's the liquidity horizon on the stock? Is there an escrow? There will be an escrow. How much is the escrow? Is it 10%, 20%, 12 months, 24 months? Right? What's the expectation of you as a founder? Will you have to stay with them for 2 years, 5 years? Do you have an earnout? Do you have retention? What is all the whole package as it comes together? Is it a clean deal, or am I better off taking this other deal where the valuation might be slightly lower, but it's a clean deal, right? Are there structures in there? Are they giving you a seller's note? All of that stuff it
Yeah.
all comes into play. So
Yes, great. Well, very exciting stuff here. And is it changing with AI this year? I mean, actually, practical founder businesses are getting more efficient. They're growing faster. They're adding AI to their products. They didn't start out as AI native, but they're moving faster and doing it more with less with AI. Are they in good stead if they keep improving their businesses with AI and adding it in practically, or do they have to get cool with AI to be a better acquisition target?
I think AI is the lipstick you want to put on every deal, candidly, Greg. I think your website, your product should scream a little bit of AI. I mean, you may not be AI native,
Scream
right?
a little bit. Yeah.
Yeah, because let's face it, AI really came out 3, 4 years back, and now there's some company that are AI native. But what about the company that have started 10, 15, 20 years ago, right? Like companies which have a lot of data, right? They can use AI to make sense of the data, right? So you can have AI in your customer support department to reduce
Yeah.
your cost. You as a company could bring AI into your coding, right? Instead of having 10 developers do the code, you might have 6, right? So you can get operational improvements there. You can embed AI into your workflow, right? And if larger company like Salesforce can do it, calling themselves Agent Force, Splunk had a whole bunch of data, right? And
There's a lot of lipstick out there.
yeah,
Mhm.
yeah, exactly. And as a smaller company, it behooves yourself to make sure that, if a buyer asks you what's your AI strategy, you do have one. Now, again, I like to call it practical AI. You can't be like, there are very few people like Sam Altman who can raise more money, and he's now talking about going public at a $1 trillion valuation, right? But the economics, if you look at how much money he's bleeding, very few people will fund a company like that. But because he's Sam Altman, there are people going after him. Not every practical founder can raise that kind of money. So I would also make sure with AI, sometimes the cost of implementing AI is very expensive. So make sure you have a good ROI on it, because at the end of the day, you're not getting funded by the VCs to build these expensive AI capabilities. I just saw an announcement that Oracle
We're
stock.
taking advantage of their funding, their
Yeah,
subsidization of
exactly.
our, practical
That's right. So you put a
value.
Yeah, so you put a wrapper on it where you're using their infrastructure to make it cheaper for you, but don't try to go into projects that are going to be expensive. Like I'll give you an example. Oracle just did a deal with OpenAI. The stock popped up 25%, but the gross margin on the deal was 14%. What
Oh
information
my gosh.
reported? Yeah. So,
Right.
you always need to look at it. Does it make economic sense? Because in the end, everyone, we have lived through the dot-com bubble, right? It crashed.
Yeah.
The AI bubble will crash too. Sure, there'll be some company that will survive, but a lot of companies will go by the wayside. And practical founders need to figure out a way to do practical AI into their products that customers will buy
Right.
and make
And
them.
that's enough for acquirers who
Yeah,
are practical about the financials and the compounding and so forth. So that means good things. There's a lot of cool kids doing really frontier things with AI, growing fast, but is it sustainable compounding and valuable to an acquirer? The margins there that eventually mean this could be a profitable
exactly.
kind of company here. Do you start implementing serious AI in a product and the cost of processing the AI, the
Sure.
tokens and right, can get quite expensive and eat into margins, right? It's almost a
Right.
tech-enabled service that the agents do
That's fine.
for you. Do you see that ever becoming an issue, or do you think practical AI doesn't really struggle with margin issues?
I think by being bootstrapped, you automatically have a discipline because if these agents and these tokens are burning your
You
cost.
just pay attention to it. Okay, there we go.
Just pay attention
That's
to it and make sure there's a demand for it and make sure, you are not at the cutting edge of AI where you're burning a lot of cash for running a product that doesn't have ROI. That's
okay.
my suggestion.
So a few, I'm sure there was a few at the Lighter Capital Summit in Park City, but you meet a founder that says, "I'm at 3 million ARR, investing to grow a little faster, and we'll be at five." They're sharing their numbers, and maybe we hear this story. I get to 10, and we'll see if anybody wants to buy it for life changing wealth. I get a number in mind. What is the most typical advice without general advice that you could share of a founder that's on that 3 to 5 to 10 march that would, uh, to make the most of their asset and, to keep going or and build it more or, to exit at the right value? What can you tell them now that would serve them later?
So one of the things, with practical founders is, for better or worse, a lot of your wealth is tied up in your business. And theoretically, every business becomes more valuable is growing. So you would never sell a business because sure, it gets to 10, one point it'll get to 50. And if you live long enough to 90 years old, it might get to 50 or 80, right? But the
Yeah,
thing
right.
is, but you may not have time to enjoy your wealth and,
Right. That's a classic
technology.
paradox. Yeah.
Yeah. Yeah. And technology changes, right? I mean, we have seen, first it was on-prem is still there, cloud, and now it's AI, right? The question is, a lot of business get displaced with new technology waves coming in, and you have to ask yourself, is there a threat that a strategic might take this niche have occupied and roll it into their products? Space become commoditized. You see a lot of venture
That
back
happens.
coming out. Yeah, you might wait to get to 10, which is a noble goal, but if you got, six different venture funded companies with sort of similar products and stronger GTM going after the market, is it worth for you to wait till 10 or get a nice pop today at 5 or 6 or 8, right? So, it's like a musical chairs because once a buyer buys that company in your space,
Right.
they're not going to buy you, right? Like after Adobe bought EchoSign, they're not going to buy DocuSign. That was it.
Yes.
So you have to ask yourself, is my universe of buyers shrinking? Is it expanding? Is my space becoming a commodity space? All these questions come in, right? And what's truly a differentiator? And if somebody gives you a good offer today, a bird in the hand is worth, I would say, five in the bush, right? So, you know, there will be knocks along the way, and if it's a good outcome, I would take it versus waiting for it. But there's nothing wrong in growing a business, but just be aware of the overall market conditions. It's always important.
So we both lived through the wrong long run, and in the long run, the market's changed, and
Yep.
not everybody, has the big exit. You and I are both talking to founders that aren't just the success stories, the poster children. We've seen all the stories out there, the bootstrapper who got surpassed, and the venture funded competitors in the old days, and vice versa. So great, really appreciate that. How do founders engage with somebody like you? Do they have a quick conversation to see if there's a fit and, you start to build a relationship? Or how do you like to engage with founders who are thinking about transacting in the next few years?
Yeah, so they can reach out to us, and what we like to do is we like to understand their business at a high level, what they're doing, what their goals are, and then we can kind of tell them based on where you are today, who potentially could be a good partner for them, and then we kind of discuss where we think the value of the company might be in today's environment based on their facts, and see if it makes sense for them. And then if it does, then we try to find a good home for them and a good outcome.
Sounds very simple, right? But the
That
flag is
is,
up and, all the complications.
yeah,
And I love how you
devil's in
just
the
rattle
detail.
off 20 things that could go wrong with
Yeah,
that and, in terms that 99% of founders have never heard of in this complicated process there.
yeah,
So
yeah.
great. Well, we'll have links to your State of Tech report, M&A, and ways to reach out to you. Do you wanna give your email address right now if somebody's interested and they wanna reach
Yeah,
out to you?
sure. They can reach out to me at my last name, Bhasin, Bhasin, at allied, advisers with E, advisors.com.
Okay. Allied Advisors. Okay, we'll have a link to that in the show notes on the
Perfect.
Practical Founders website and all of that. Uh, Gaurav, I really appreciate you sharing some insights. I know you shared a lot and brought in founders to help that have been through the M&A process at the Lighter Conference and were very helpful there. I really appreciate it. Thanks for helping my friend and practical founder Landon through selling a piece of his company last year. And we're going to hear from the other side, Darshan Rangagauda, in a couple weeks on the Practical Founders podcast, who you helped sell his company as well.
Sounds good. Greg, nice connecting with you. Really appreciate the work you're doing. And I think, I met with a VC last week, and he's actually going to start a fund that just focuses on 99% of the other businesses. These are other businesses that are not right for VC, but they're good for, lightly capitalized or bootstrapped. And I think there's a big market out there.
Right. Lightly
So,
capitalized. I like going to Silicon Valley and say lightly capitalized. And they all say, what does this lightly capitalized you mean? Meaning, it's just the fundamental math. VC, I want to grow this efficiently to 10 million, sell it for 70. That, Silicon Valley, that isn't even something that's basically interesting, but there's a place for it. Practical funding. It's a pretty small place out there, but there are practical funders out there that would like to help these guys.
oh,
And
absolutely.
Lighter Capital's part of that practical funding support
Sure.
and therapy support out there. So really appreciate it, Gaurav, for being on the Practical Founders podcast. Thanks for sharing your knowledge.
Sounds good. Thanks for having me, Greg. Talk to you soon. Thank you. Bye-bye.
Thank you. Thanks for watching this week's interview on the Practical Founders podcast. Be sure to like this episode and subscribe to the Practical Founders YouTube channel to keep up with my weekly in-depth interviews with serious software founders who are building valuable software companies without big funding. You can check out my blog, all the podcast episodes, and information about my Practical Founders CEO peer groups at practicalfounders.com, or message me on LinkedIn if you'd like to connect. See you next week.